Okay, great. So let's continue, right? So why do people demand money? That's what we are discussing. So the first one was transactionary motive, and that is people want to hold money because they have to make their day-to-day transactions, right? Like paying for their bills, like buying foods, groceries, right? Paying for their transportation expenses and things like that, right? Now, what is precautionary motive? Precautionary motive is that people want to hold some excess cash, right? Some excess cash or money in case of any unforeseen circumstance, right? Now, what do we mean by that? Think about it. Now, the idea is if, let's say, my assessment is that I need 50,000, 60,000, 70,000, whatever amount of money to make my daily transactions, right? Let's say to pay for my bills, to buy the food, to buy the groceries, to pay for my fuel and all that stuff. But it's quite likely that in some cases, I might need some extra cash, right? So for instance, if let's say on one day my car tire goes flat and I have to put some money, right? Pay some money to get that fixed. I mean, that was something that I could not foresee. Similarly, if on some other day something else, I go to shop and I like something and I want to buy it, right? So that is also some precautionary motive, right? So I will also put some money aside to make these other transactions which were otherwise not scheduled, which were otherwise not, planned. That's what I mean, right? So that is precautionary motive. The people, the money, that people want to hold some excess cash money in case of any unforeseen circumstance, like an emergency, right? Is making sense, Preet? Like an emergency or impulse buying. Impulse buying is when you want to buy something right there and then, right? Impulse buying, etc. Okay. Now the third one, this is important and I want you to pay close attention. Now, what is speculative motive? Speculative motive says, right, says people would want to hold cash in case interest rates offered by banks are low, right? What do we mean by that? Think about it. Now, as a saver, let's say if I earn X amount of money per month, right? Or let's talk about any individual, right? So let's say an individual makes this much amount of money per month, right? Now, either he would be spending all of it or he or she would be saving some of it, right? Now, let's say if this is someone's income and the person is only spending 70% or 70,000 out of this income, then the remaining amount is being saved, right? This is how it works. Now, as far as the savings are concerned, spending, right? Right. So this is spending or the consumption that this person is making per month, right? Spending or consumption. Now the remaining 30,000 is being saved. Now, what options this person has about the savings, right? So what will this person want to do with the savings, right? And this is a very simple and obvious question, right? Basic question that anyone would ask him or herself in case they're saving some money. Now, according to this theory, there are two options available for this person to save their money, right? Either they can put their money in a bank account, right? As we just discussed earlier on, right? So either you can put your money in bank account, which pays you some interest, or you can just save your money in the form of cash. You can just, have this extra cash lying in your bank, sorry, lying at your in your wallet or something, right? So according to this theory, there are two options that are available for an individual when it comes to saving. So either to put the money in a bank and receive some interest, or to just hold this extra cash in the wallet, right? Right, exactly. Now, speculative motive says that if the interest rate that the bank is offering is low, right? So let's say if this is low, let's say too low, right? Um, uh, right? If this amount is low, 5% or 6%, and the saver doesn't want to put their money in a bank, then they will hold their saving in the form of cash just in case they get a better opportunity to invest, right? Hold money, hold savings in cash form till you get a better opportunity to invest your money. What could be that better opportunity? Perhaps to invest in a real estate or to invest in stock exchange or whatever, right? Till you come across a better opportunity to invest, right? Is making sense? So that's what the speculative motive says. And that investment could be in any thing. That could be investment in real estate, that could be investment in stock exchange, that could be investment in any business, right? And so on and so forth, right? So that's what it is. Okay, now moving back and writing this down, right? So it says speculative motive says that people want to hold cash in case the interest rate offered by banks are low, and therefore they would want to cash till they come across better opportunity to invest, right? Stock exchange or real estate, etc. Right? Could be anything, right? So that's what the speculative motive says. So long story short, according to liquidity preference theory, these are the three reasons why people want to hold cash: transactionary motive to make their day-to-day transactions, precautionary motive just to hold some extra cash in case they need it, and speculative motive, right? Which means that in case the interest rates offered by a bank are low, then people would want to hold their savings in the form of cash so that they can invest that money whenever they come across a good opportunity. Now we'll move towards the graphs and we'll see that how the graph of each of these three look like. So the first one that we'll make here would be the graph for the transactionary motive, right? So the graph for the transactionary motive, and then we will look at the other two, precautionary and speculative motive, right? Transactionary motive. Okay, now have a look at this. What we will have on the y-axis, right? So it will be a normal graph, just like we have made it, just like we make it for any other thing, right? So on the y-axis of this graph, you will have interest rates, right? And on the x-axis, you will have quantity demanded or quantity demanded of money, right? So on the y-axis, you have interest rates, and on the x-axis, you will have quantity of money demanded or money demanded. Right? Okay. Now think about this. Preet, here's now when we have to make the graph. Okay. Now think about an individual who has to make whose monthly expense. There's an individual who, like, let's say, think of a normal typical individual who works in some company, and he or she knows that his or her daily monthly expense is 50,000, right? So all the expenses that he or she has to pay for, and things like that. So his or her monthly expense is 50,000 rupees. Now that being said, even if the interest rates, think about it, even if the interest rates offered by the bank are higher are increasing, even if the interest rates offered by the bank are high or are increasing, do you think that can this person afford to put this 50,000 rupees in the bank, like to deposit it on a more long-term basis? I mean, just lying money in a bank is not a problem as far as current account is concerned, because you can withdraw your money anytime. That's not the thing that I'm talking about. But what I'm talking about, that can you afford to not have that money available to you, the one that you want to expect, that you're expecting to spend for your transactionally motive? Can you afford to not have that money available or to be deposited in a bank for a long-term basis? Can you afford to do that? right? The answer is absolutely, the answer is no. Why? Because you know you need this money for your daily transactions, right? So you would not want to put your money aside or deposit it for a long term period, right? So this 50,000 rupees, this is how the graph for your transactional motive would look like, right? For regular transactions. Excellent. And why is it a straight horizontal line? So this transactional motive would look like a straight horizontal line because it shows that regardless of how much is the interest, regardless of how much is the interest rate, you would want to hold that amount always, right? So whether the interest rate is 5% or 8% or 10% or whatever, right? You would always want to hold this amount of money, right? 50,000 rupees. Is it making sense, right? Okay. So whether the interest rate is high or low, you are always holding the amount of money that you need for your regular transactions. And this type of graph, you already know, it is known as perfectly inelastic. So you can call this, that transactional motive is perfectly inelastic with regards to interest rate, perfectly inelastic demand, right? Inelastic demand would mean that no matter what's the change in the interest rate is, your demand for transactional motive stays the same. Perfectly inelastic demand. Does it make sense? Okay. Now, similarly, very similar to this graph, you will see that the precautionary motive would, the graph for precautionary motive would also look like this. Why? Because again, the concept is similar, that if you need a certain amount of money as a precaution, right? If you want to hold certain amount of money as a precaution, right? Then no matter how high or how low quantity demanded of money, right? How high or how low are the interest rates, you still that need that money in case of precaution, right? Yes or no? So the graph for precautionary motive would also be perfectly inelastic. So let's say this individual, same individual that we were talking about, this person needs 10,000 in excess of transactionary motive in case something goes wrong, right? Or if he or she needs money urgently. So again, you can see from the graph that whether the interest rate is high or whether the interest rate is low, right? Your precautionary motive is staying the same. The money that you need for your precaution is staying the same whether the interest rates are going up or down, right? Again, it's perfectly inelastic demand. So precautionary motive is also perfectly inelastic. Inelastic, right? Easy, we good on this? Any confusion about it, right? Okay. Now, this being said, now we are coming towards the third and the last one, and that is speculative motive. Now, as far as speculative motive is concerned, Preet, this will vary. Speculative motive or speculative demand for money will depend on the interest rates. Why is that so? Because the idea is fairly simple. If interest rates are high, then as I said, then people would prefer to put their money in a bank because that is paying them a better interest. But vice versa, if interest rates offered by banks are low, then people would not want to put their money in a bank. And therefore, in the case of speculative motives, the demand curve would look like this. Why is demand curve down sloping? Because you can see that there's inverse relationship between interest rates and demand, speculative demand for money, right? Higher the interest rates, then people would want to hold less cash and put more of their money in the bank, right? Have a look at this, right? So let's take 2 points and that will clarify the concept, right? On point A, you could see for yourself, right, that interest rates are higher. So this means when you put your money in a bank, you get better return. So what will most people do? Most people would want to deposit their money in a bank and hold less cash, right? Put more money in a bank and hold less cash, right? So let's say this person is only holding 5,000 rupees in cash and the remaining excess amount is deposited in the bank because that pays them higher interest. Whereas when the interest rate drops from 10 to let's say something very low, let's say 3% or so on and so forth, right? Then people would want to hold more cash. The reason being that they would be on the outlook of an opportunity where they could invest their money in, right? So when interest rate decreases from 10% to 3%, then the demand for money will increase from 5,000, right? So you were previously holding less cash and more money in the bank. And now when you move to point B, since interest rates are lower, so you are holding more cash so that you could invest this money in case a good investment opportunity comes up. Any confusion so far? We good on this? Okay. Now the overall demand for money, the overall money demand curve, how will the overall demand for money would look like? So overall demand for money, breathe, great, would be a downward sloping curve. Just like the speculative motive, the overall demand for money curve would be a downward sloping curve, right? So interest rate is on the y-axis, right? And you have quantity demanded of money, right? Okay, now the graph for demand for money would be a downward sloping curve like this, right? Got it? Which basically simply shows that higher the interest rates, lower the demand for money, right? And lower the interest rates, higher the demand for money, right? So inverse relationship between interest rates and demand for money. So when interest rates were high, right, demand for money was low, right? And when interest rates are lower, demand for money or cash is higher, right? Got it? Simple. We're good on this, right? So when interest rates decrease, demand for money increase, right? Okay, now this was the demand for money. Now coming towards the supply of money, because obviously we know in the liquidity preference theory, we just talked about it, that interest rates will be determined. According to liquidity preference theory, interest rates will be determined where the demand and supply of money are equal. Now, who is demanding money? Individuals. We have talked in detail that why do people want to demand money? What are the three reasons? What are the three motivations for demanding money? And now we are talking about that who supplies money. And who supplies money? The answer to that is who supplies money? And the answer to that is central bank, right? Now think about this. Central banks supply money, right? Print currency notes on the basis of how much is needed in the economy. So central banks print money based on the economy's need, that how much money would be, how much is the right amount of money to be printed. So therefore, it means that the supply of money will be fixed during a certain point in time. The supply of money would be fixed during a certain point in time. Why? Because central bank is not printing money in the by considering how much is the interest rate, and instead they are just printing money based on how much is the need, for the economy. So so therefore the supply of money would be completely inelastic and regardless of how much is the interest rate in the economy. So where the supply and demand for money intersect, that would be, according to liquidity preference theory, that is the equilibrium. That would be the equilibrium point in the money market, and that will determine the equilibrium interest rate. So this is what liquidity preference theory says. Any confusion? This is what liquidity preference theory says. Got it? Okay, any confusion so far? Perfect, right? So Preet, I think we should stop here for today, and tomorrow we'll continue from here. Right? Does this sound good? Right. So, okay. So I'll see you tomorrow. Right. Take care. Bye.